All right, guys, it's Sunday, December 9th, and I'm recording this economic update. And there's been a couple crazy weeks, economically speaking, both in Canada and the United States. So I'll start off with this article from the Financial Post on December 5th, 2018. This came out. The Bank of Canada's Stephen Poloz holds key interest rate at 1.75%. Canada's central bank took a break from raising interest rates on December 5th. The pause could last longer than many were expecting, mostly because policymakers are worried that the energy industry's contribution to economic growth will be materially weaker than expected only a couple months ago. Recent developments suggest a weaker economy will curb inflation, alleviating the need for the central bank to add an additional headwind. The negatives outweigh the positives in the Bank of Canada's new statement, a shift from October when Governor Stephen Poloz and his deputies on the Governing Council raised interest rates a quarter point. The news since then has been mostly negative. Policymakers observed that indicators suggest that Canada's economy had less momentum going into the fourth quarter, that U.S. President Donald Trump's trade wars are weighing more heavily on global demand, and that oil prices have fallen sharply. They also noted that new estimates of gross domestic product show the economy is smaller than previous thought. That means there could be less pressure to raise interest rates. The latest assessment of the state by Canada's central bankers wasn't entirely dreary. They expressed confidence that non-energy investment would strengthen in the months ahead. Oil notwithstanding, data suggests industrial companies are struggling to keep up with new orders and will need to add capital if they want to grow. The signing of the new North American trade agreement makes the future more certain, and the Trudeau government's promise to cut taxes on investment and reduce regulation should make Canada more competitive, the central bank said. Also, since I reported last, you can see here that the latest figures came out for our GDP growth, our third quarter GDP growth, as well as September figures. This article from the Huffington Post on November 30th states that some dark clouds have gathered around Canada's economy in the past few months. Although this article says that might be good news for the country's most indebted households. So I'm not sure if this writer's being a bit funny, but as the economy shrinks, and I've talked about this before, there's this sort of paradoxical result that the central bank will then not raise rates as quickly as they might have before, which of course, if you're heavily indebted, you don't necessarily want to see those interest rates going up. But the reason I brought this article to your attention is mostly that it has the figures on the GDP growth released just over a week ago. It showed that the third quarter growth slowed to a 2% growth rate in the third quarter, down from a growth rate of 2.9% in the previous quarter. So our GDP growth is slowing. The experts had been expecting a bit of cooling. What they hadn't been expecting was for the economy to start shrinking altogether, which is what it did in September, the latest month for which there is data available. So Canada's economic output shrank by 0.1%, surprising the forecasters who had expected 0.1% growth. Some important parts of the economy are losing steam. Oil and gas declined for the third time in 4 months. Manufacturing has shrunk for 2 consecutive months, and that's before this fall's oil price tumble and General Motors' announcement that it's shuttering its Oshawa plant. Canadian oil sands crude was selling for little more than $11 US a barrel on Friday, which represents a 77% discount compared to the benchmark North American price for oil, which was trading at around $51 US on Friday. Importantly, residential construction has shrunk for 4 straight months. Meanwhile, Canadians' wage growth is softening, with inflation-adjusted disposable incomes up just 1% in the past year. The savings rate plunged near all-time lows as Canadians dipped into their nest eggs to compensate for weak real disposable incomes, according to the National Bank financial economist Christian Rangasamy. A recent Environics survey for the Institute of Corporate Directors found Canadian business leaders are seriously worried about what's going on economically and politically around the world. Only 28% of Canadian board members predicted the country's economy would improve over the next 2 to 5 years. 52% predicted it would worsen. And of course, something myself and many of you have been following over this year, and especially recent months, is the Metro Vancouver real estate market, which has been just so much slower than last year. We've been seeing major declines year over year, each month, starting, I believe, roughly back in really spring, early spring of this year, and it just continues. So the Vancouver Real Estate Board released their statistics for November just last week. This article is from December 6th, 2018. It's from the Daily Hive, dailyhive.com. Metro Vancouver home sales hit lowest level since 2008's Great Recession. Not a good. That's obviously not a good mark to be hitting. The trough of Metro Vancouver's real estate market continues to deepen, according to new data released by the Real Estate Board of Greater Vancouver. Home sales in the region for the month of November 2018 reached 1,608 units, representing a 42.5% decrease from the same period in 2017 and an 18.2% decrease compared to October 2018, just the prior month. So those of you who've seen my previous video, you'll know that this kind of 40% plus decrease year over year is not just a 1 month phenomenon. We've been seeing this month after month. It really looks, that 2018 overall has had significantly fewer real estate sales. And so far prices have been resilient, but they are starting to come down. In fact, the article continues, home sales for the previous month were 34.7% below the 10-year sales average for the month of November, so they're below historical averages as well. And it was the lowest sales of the month since 2008, when the Great Recession hit. Over November, compared to the same period last year, detached home sales fell by 36.8%, 46.3% for apartment units, and 36.8% for attached units. Overall, for all home types, benchmark prices now hover at $1.042 million, a 1.4% drop over November 2017, and a 1.9% decrease compared to October 2018. Compared to the previous month, benchmark prices decreased by 1.6% to $1.5 million for detached homes, 2.3% to $668,000 for apartments, and 1.3% to $818,500 for attached homes. So a couple points here. We are now seeing month-to-month decreases or declines in prices for all of the different segments. That's new. Also, this annual decline in benchmark prices for all homes, that is new as well to my recollection. As this article states, we're now seeing a 1.4% drop year over year. That is a new development. So, if we're finally at a point where sales this month are lower than this month are lower than they were this time last year. We also saw on a national scale that home sales edged down 3.7% year over year and 1.6% from September to October. It's not just limited to the lower mainland of British Columbia, but across Canada, we've got a smaller but still real decline in home sales. I want to share this article with you from huffingtonpost.ca. Once again, November 29th, this article came out. Why Canadians really need to change lenders at mortgage renewal time, especially now. I didn't want to share it with you so much for the author's purpose of talking about why you need to change lenders, but just for an interesting couple of facts that are in here. First, to provide some historical perspective, you can see in this article, it says, for the first time since the early 1990s, the interest rates that banks base their fixed rate mortgages on are higher than they were 5 years earlier. So just to pause there, just to think about that, for the first time since the early 1990s, mortgage borrowers are going to have a higher interest rate when they refinance. And I found that just so shocking to read, thinking that it's been that long since mortgage rates were higher at the end of a mortgage term than when a person started. So that to me points that this has a chance of not just being a sort of momentary cycle or a regular momentary cycle in the real estate market, but that perhaps something more fundamental is shifting here. If for the first time in 25 years, borrowers are having higher interest rates at the end of their 5-year term, perhaps this is pointing to us that something different is happening with interest rates on a more fundamental level. And another interesting piece from this article, it talks about serious financial pressure for some home borrowers. In a new survey carried out for mortgage comparison site RateHub, 31% of mortgage holders said they could afford no more than a $100 increase to their monthly payments. On a mortgage initially worth $400,000, it would take only a 0.6 percentage point increase in rates to make that happen. And the data here, comparing this information to the real data that's coming, would suggest that the average increase to monthly payments is going to be a lot more than $100. I mean, even just, for those, let's say, who have double the mortgage, that would be a $200 increase. And let's say double the interest rate, that would be a $400 increase. I mean, I know I'm just doing rough and tumble numbers here real quick, just to make the, perhaps, obvious point then that, a lot of, if 31% of these people are going to be struggle with what we're expecting to come ahead, and perhaps even more people will struggle, since the increase is likely to be more than just $100 each month. But the chances are good your own lender will make things even worse at renewal time. That's because mortgage lenders tend to give higher rates to borrowers who are renewing than to new customers, according to Rob McLister, founder of RateSpy.com. A great number of people don't do any comparison shopping whatsoever, and the banks take advantage of those people by offering higher interest rates at renewal. That's one of the ways lenders maximize profit. There's not the reward for loyalty that you would expect. So if you're watching this and you have a mortgage and you have a renewal come up, I would highly encourage you to give them a call and at least try to negotiate a lower price and try to be a bit of a hard negotiator with them, and you'll probably find you can get a better rate without too much work. But this isn't anything new. But what is new in the mortgage scene that's going to affect this going forward quite a lot is the new stress tests, and this article does talk about that as well. So here you can see that the new federally mandated mortgage stress test complicates things. You'll have to pass the test at renewal time if changing lenders, but if you stick with your current lender, you don't have to pass the test. The stress test requires that you qualify at a rate that is 2 percentage points higher than the one you're being offered, or the Bank of Canada's posted rate, currently 5.34%, whichever is higher. And by the way, that posted rate is also going up roughly every single quarter. So this isn't getting better if you're in this position, this is getting worse. It applies to any federally regulated lender like banks and mortgage loan companies. Credit unions are mostly provincially regulated, but provinces often look to federal standards to set their own policies. So what this means, practically speaking, and the RateHub has a quote here, but I could just explain it in my own words, is that if you have to qualify under this new stress test, but you only have to do that if you're going to a new mortgage lender. So if you stay with if you just renew your mortgage at your same lender, you don't have to qualify. Now, what that means is anybody who got their mortgage at a time before these stress tests came into play, it was January, then your financial pictures could be a lot different from when you got that mortgage and today. And there's going to be some segment of borrowers who wouldn't qualify under these stress tests. I mean, it's you're having to qualify at 2 percentage points higher than what your actual interest rate is, whereas before you just had to qualify at what your interest rate was. This means that any marginal borrower, any borrower who is close to that cutoff of not being able to borrow that full amount of money, which is not going to qualify under the stress test, which means they cannot go to a new lender. So you cannot go to a new lender if you can't qualify under the stress test. So your ability to shop around for a new mortgage rate upon renewal is going to be severely limited if you're in this situation. You'll be stuck with certain alternative lenders or perhaps certain credit unions, and likely you're going to be looking at higher interest rates there. So and of course, if you're one of these people where $100 a month is going to sink you, then that's no solution at all. So this is a new significant piece of this refinancing puzzle that is put into place, and I think is really going to it's really going to make things harder for people come renewal time, and I think it's going to compromise a lot more people than they were expecting. Particularly because we all know that so many new home buyers maximize out their borrowing capacity. They look at their income and they'll go and they'll buy the most expensive property that they can. And when you do that, of course, your income qualification is stretched to the maximum. So if you go from that just a couple of years ago, and your income has only gone up 1% or 3% or 5%, all of a sudden your interest rate that you need to qualify at is 60% higher. There's just there's no way for you to make up that ground so quickly. Another significant trend here in the Canadian economy is the price of our oil, which I touched on earlier. So this article here is just to let you know that. So, the Alberta government is, I'm sure they're terrified right now because they're losing billions of dollars. This article is from the nationalpost.com from November 29th, 2018. Can more trains really save the Alberta oil sands? Here's what you need to know about Premier Notley's plan. If oil isn't moving by pipeline, the oft-touted next best option is hauling oil by rail. That's the plan Premier Rachel Notley has hitched her political future to, given an estimated $80 million lost daily to the Canadian economy because of low oil prices and billions lost to the Alberta Treasury. The Alberta government will purchase rail cars to increase export capacity by 2 trains, or 120,000 barrels per day. We're not wasting any time, she said in a speech to the Canadian Club of Canada in Ottawa. But it's not quite as simple as just filling up tankers and sending the trains on their way. Already, shipments of oil by rail are up. Between January 2018 and September 2018, the amount of oil shipped by rail each day grew from roughly 144,000 barrels per day to just shy of 270,000 barrels per day, according to the National Energy Board. And some critics say Notley's plan will be too little, too late. So just to stop here or slow down for a second here, a couple main points. So between January and September, a significant increase in the shipment of oil by rail, almost doubling. So any environmentalist listening to this, trying to take victory points, one of the unintended consequences of your action is to drastically increase the shipment of oil by rail, which is significantly more dangerous than shipping it by pipeline in terms of environmental risks. So that's one takeaway. The other, of course, here is that the Alberta government is sort of just sliding into infrastructure, into oil transportation and rail infrastructure. This should be a flag to people, but of course it is, has become relatively normal as our economy and our government, as we become more and more socialist, and this sort of thing just doesn't really strike people as odd anymore. And of course, there was a time this was not just it was perfectly normal. But I don't think it's normal. I don't think it's right. So I want to point it out that of course the Alberta government here is just casually walking into the transportation infrastructure industry in Alberta, I predict it's going to go very poorly. I mean, really, the question we should be asking ourselves, if it's such a good idea to be shipping more oil by rail, if this is such a good idea to be buying rail trucks, if this is good for the oil economy, then why isn't anybody willing to voluntarily put their money into it? Why isn't anybody in the private sector stepping up and saying, hey, let's double our rail transportation of oil? That should be a big red flag to anybody who's supportive of the government making this kind of step. Almost more concerning for Albertans and for the state of politics in our country, and more specifically in Alberta, as this was developing, I was hoping that Jason Kenney, the leader of the United Conservative Party in Alberta, I was hoping he would take a free market approach and provide the correct free market analysis of the problem. Unfortunately, Alberta does not have the benefit of a free market leader. Jason Kenney revealed himself to be just a socialist who likes blue jackets. And I don't know how he would define himself as a conservative. That he ultimately, when push comes to shove, believes in this kind of command and control economy, this sort of the socialist idea of fixing economic problems. So that's probably even more concerning. It's not too surprising that an NDPer would have these false ideas, but when your opposition, who claims to be a conservative, is talking in these in this same way, it's of course even more concerning, because there's really no way out for Alberta. Even if you vote in Jason Kenney, you're not going to get a free market government. So that I saw that, and that was definitely more disappointing and more concerning to me. And then just a few days later, I think Premier Notley in Alberta realized that her rail plan wasn't really going to cut it, since the rail cars aren't going to be online for many, many months. And really, it just, there's going to be a host of unexpected problems with that. So just a few days later, on December 3rd, 2018, the Notley government announced that they were mandating production cuts for all producers in the province. So she took Jason Kenney's lead on that point, frustratingly. So, of course, there can be some benefits and some losers, but if you understand economics, you'll understand that as a whole, the economy will suffer from these arbitrary production output cuts. Effectively, I mean, you can't cause more money to come into an industry just by reducing production. Effectively, you might increase the price per barrel, but that's only coming by lowering the number of barrels that you can sell. So, I mean, one of just the more obvious consequences of this is that this will benefit less efficient oil companies. That's, one immediate one, because they would be suffering otherwise under this the most. But now, if they can't produce as many barrels at these low prices, they're going to have less suffering, which is great. Isn't it just great? Less suffering, except that these were businesses that were, I don't want to say poorly run, but in the current reality, in the current world we live in, we're struggling, right? So their model doesn't work. We do not want to be sustaining, these economic models or business models that don't work. That's a really good waste of money. It's a really good way to make sure we all stay poorer. And the other major piece of economic news coming out of Canada in the last couple of weeks was this the Oshawa plant closure for General Motors. And this article here from globalnews.ca, released on November 26, 2018, says that the Oshawa plant closing could affect nearly 15% of auto industry jobs, which is huge, as you can imagine. So we're now talking about major declines in real estate in BC. We're talking about, major price crises in Alberta oil. And now we're talking about manufacturing problems in Ontario. And this article here tells us that General Motors' decision to shutter its flagship Oshawa, Ontario plant in 2019 is poised to have a broad ripple effect across Canada's auto industry. The plant's closing will put more than 2,500 employees out of work, but the blow to the Canadian auto sector workforce is far larger. The move could compromise the jobs of as many as 15,000 Canadians working for auto parts suppliers, according to Flavio Volpe, president of the Automotive Parts Manufacturers Association. And if you're wondering what that exact figure is, this person estimates that to be about 125,000 auto industry jobs. And just here, for those who might have missed it, GM formally announced its decision to shut down its Oshawa facility on Monday as part of a global restructuring plan that will also see closures in Michigan. I'm going to finish off this update on the Canadian economy with this article here. GM in for one hell of a fight over planned Oshawa plant closure, according to the union. So the union representing workers at the General Motors assembly plant in Oshawa is promising one hell of a fight after the automaker announced it would close the location along with 4 other facilities in the US as part of a global reorganization. Hours after GM's announcement, Jerry Diaz, national president of Unifor, stood before a union hall overflowing with anxious GM workers and said the union will fight against the planned move tooth and nail. I just wanted to share this article with you, not so much because I think that the union will be able to succeed in any way with this, but just to remember that, of course, a lot of people, when closures like this happen, it's just not just an economic event on a macroeconomic scale, but real men and women are losing important jobs and in some cases careers. All right, that's it for this week's economic update. I wanted to include a whole lot more stuff, but this video is already long enough, and the day is just getting away from me here. There's a lot more going on down in the States that I wanted to cover, including changing perceptions of the Federal Reserve and how it's perceived that they might raise interest rates at a lower rate. The stock markets down in the States have been just crazy, particularly in the last week or so here. So perhaps I'll be able to put that together in another video. I think going forward I'll try to make these updates a little bit more frequently so that there's not so much information to put into one video. I'll also hopefully be back to making my Tuesday night movie reviews. I apologize to those of you, if you're out there, if there's anybody out there who has been looking for them. I've just had plans the last couple Tuesdays I haven't been able to reschedule. So I haven't meant to drop those, I just haven't been able to do it. And hopefully I'll be able to get back to the movies this week. Thanks very much for watching. Goodbye.